And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Thank you for joining me today. A lot to talk about. Oil keeps spiking, but be careful. Because what are we noticing in an oil? And I've been in the oil business for years. When you see oil, the people who explore for it, like Exxon, Chevron, they explore, they find it, but they don't take it out of the ground. When you see like Halliburton, Baker, all these companies that pull it out of the ground, when you see their stock is rolling over and going down, but the oil stocks of the people who go out and explore going up, that tells you got to be a little careful. Now, we've done very, very well with our oil, our gang members. We've been in it for a long time. I got them in early, really early, when oil was about $58. And I had them follow the ETF, XLE, and XOP. Those are great ETFs for oil. But anyways, so oil is spiking. That's what's causing the problem. That's pushing up interest rates. That's pushing up the yields. And as these yields keep climbing, because the investors I told you yesterday that are already in treasuries, they're not going to buy any more treasuries. Okay, they're just going to let the yields keep going up. The people who don't have a lot, or people who don't have any, they're not going to buy. They're going to wait till yields keep going up. Yields are a killer, and yields can kill our deficits. So we got a lot of problems here. They got to find a way to stop this oil price from going up. But what's really been amazing, that amazes me, is that even though yields, okay, are setting a panic button, the retail investor really keeps losing money. He just won't learn the lesson that when you look at newsletters, I mean, these people who look at newsletters, those are the worst thing in the world, newsletters, okay? They do nothing for you, okay? I mean, first of all, when they sell you a newsletter and you buy it because you want to get the top 10 stocks to buy now, or strong earnings winners, I'll give you those, or low PE ratio bargains, man, get my newsletter, I'm going to show you those bargains, or value stock, get my value stock list. It's all crap, it's all garbage. The reason that it used to be a $15 billion industry, now it's only a $5 billion industry, because it's a fraud, okay, in a sense. Because, you know, as I tell you about in 2008, and I keep telling you, you've got to follow institutional money. It's the same thing. People won't follow institutional money, and they want to follow, you know, fundamentals because they feel comfortable. Because Wall Street, one thing about Wall Street, they're storytellers, and that's what it's all about, telling a story. And fundamentals work with storytelling, and what investors fail to realize, both with newsletters, okay, and with all this storytelling fundamentals, it doesn't work, because it can't tell you. A newsletter can't tell you. Fundamentals can't tell you where are the institutions going to push the money. Is it going to be in tech stocks, retail stocks? Remember, the institutions, the day in 2008 that they got that 13 trillion, that was the end of newsletters. That was the end, okay, of fundamentals. They didn't work after that. They just didn't, because fundamentals can't push money anywhere. Fundamentals can't identify what stocks are going to be purchased. They can't do that. They just have no, it's impossible for them, for fundamentals to direct you to the stocks that they're going to be bought or sold. It's just ridiculous. And so the newsletters are the same thing. They can't tell you when you get a newsletter and they give you 10 stock, they have no idea. The only way you can find, okay, where is the money going is through the institutional money, because as I told you over and over, when they push that institutional money through channels and it's going to go directly to stocks they're going to buy or sell, you will see that footprint. Okay, you can see it on your chart, and it's easy to spot, okay, because it's all about the footprint is made up of volume, okay, and I mean it's so easy to, and you got your volume, you got momentum, and pricing. So if you follow those three things and you know how to spot those three things on a chart, you know exactly where the money's going. We're looking at stocks today. We knew. You could look right at them, and I could tell my members, this stock is not being purchased right now by the institutions. This stock, they're selling, they're getting out. And once you catch how to use the price and the volume and the momentum, and you understand that's the footprint you're following, that's how you know an institution, what a difference it makes. What a difference. So in 2008, as I said, everything changed. The fundamentals stopped driving stock price. Fundamentals can't tell you if a stock price is going to go up or down. They don't have the power. So the newsletter industry in 2008, just like Wall Street, you still use fundamentals. And why do they use fundamentals when they don't work? Because they can control the retail investor through storytelling. That's why for 18 years, they've been masking how terrible fundamentals are and how terrible newsletters are, because they don't have the ability any longer. That stopped in 2008 to identify the money. Where is it going? Is price going to go up or down? Do you realize that newsletters and fundamentals can't tell you where the money's going, can't tell you if prices are going to go up and down? What the hell good are they? They're not. But Wall Street uses them all the time. Now, something's got to be bad. When the industry went from 15 billion to 5 billion, were you nuts? 80% of newsletters underperformed the market. About 10 to 15% beat the market. That's it. And the newsletters don't help retail investors, just like, because there's no accountabilities. And again, fundamentals, same thing. There's just no accountability. It's terrible. So once the Fed controlled the source of liquidity and the institutions controlled the direction, it was over. So what they did is continue to use these tools to mask what's really going on, to make them look intelligent, to make them look, like they're, geniuses. And like these newsletters, when they give you the top 10 stocks and the low PE bargains and all that, like you're going to be on a magic carpet going to profit land. You're not. You're going to get screwed. So newsletters don't help one bit. All right. So stay away from newsletters and start thinking about. No longer are you going to listen to these guys on Wall Street, the jibber jabbers, when they give you the fundamental reasons why to buy stocks, the free cash flow, earnings, all that, PE ratios. It's all BS. Okay. So you don't need that. What you follow is, once you start following the money and the footprint of the money, you know exactly what stocks to buy. So those two things are killing, are killing the folks. They just are getting clobbered. Now, let's talk a little bit too about what's going on now with oil going up and yields and all that. So yields are setting a panic, because yields are going up. And that makes our deficits worse, because it forces our government to pay more in interest. And so again, they don't explain that to you either. Everything's based on fear. I'm going to give you one cut. What was the cut on? I don't remember the name of it. The other one, yeah, not rate cuts, the other one.
Productivity growth just slowed hard. We're talking down sharply after a much stronger previous quarter. And think about this. It's exactly what happened before the past recessions. We're talking 89, 2000, and 2007. Productivity drops just like it is now, demand fades, and the unemployment rate shoots up. And that means more layoffs are coming, more businesses defaulting, and more private credit loans blowing up just like BlackRock.
That's what newsletters and fundamentals are supposed to do. They work on fear. And as long as they control these newsletters, and as long as they control these fundamentals, and they don't have to tell the truth that fundamentals don't work. How can they? They don't do anything. They're dormant. Fundamentals can't help you. They used to before they put the $13 trillion shift it to institutions, so that institutions now control the flow of money and control the stocks. It identifies what stocks they're buying, how prices are going to go up and down, what direction the stocks are going to go. Fundamentals don't do that. They do nothing. And newsletters do nothing. So we got to, until people start learning that if you could just follow the path of institutional money, what a difference it makes in your financial life. The amount of money you start making trading, you're just not going to believe. But what upsets me, for 18 years, Wall Street's been able to mask the fact that fundamentals and newsletters can't do anything to help the retail investor. They can't. What it's there for now is a tool to make these guys on Wall Street, look, and sound responsible, academic-like, intelligent, when they're not. It's all set up. If I can get them to be fearful, they will follow anything I say. I just got to give them a good story. So when you hear these guys that come on, I don't care if it's TV or radio or whatever, and they start rapping all these bad things, all this bad news, all bad news, then all of a sudden they have a solution. How about this stock here? Well, what you're going to find out, those stocks were purchased maybe a week or 2 weeks early. That's right, by Wall Street guys. They already bought those stocks. You're paying retail. Now, I want to get back to these yields because this is going to really screw up. And this is the economy, the stock market. You got to know how to sell short. So yields are setting a panic, exactly what Wall Street jibber jabbers want. They want to have that fear because they know once they got you fearful, you will follow them anywhere. You will follow them anywhere. They know that, okay? And so the U.S. deficits are going to get so bad now, okay? The government has to start paying higher interest rates on $34 trillion. That's going to hit the cost of every federal program. They're all going to go up. It's crazy. So again, it's going to explode the interest cost on all these programs. And it's going to be, and the problem is our growth in our economy is going to stall. Going to stall. And what happened, inflation will raise every program, Social Security, Medicare, federal pension, defense contractors. This is bad stuff. So now what you're going to do is you're going to start listening to Wall Street, right? Play that other one. Play the other one in the cuts.
In fact, I actually think the Fed is going to cut rates a lot more than what's priced
this
into
year?
the market. Oh, yes.
How many times?
A whole bunch of times.
Yeah, this guy's a dope. This guy. How are you going to cut rates when yields are going up, when inflation's going up? What do you mean cut rates? You got to raise rates, but they're not going to do that. So, and remember, the more inflation, it cuts into our purchasing power. Now, why am I talking all about this? because I don't think people realize what's going on. There's a tremendous opportunity in this stock market, because if you know how to sell stocks short, you're going to make a boatload. You know how well we've been doing in shorting bank stocks? Incredible. We've been shorting tech stocks, bank stocks. Our shorting has been fantastic. You've got to learn how to sell short. And we'll be happy to do that. So please, no more newsletters. Stop listening to fundamentals from these gibber. They don't work. They trap you. And you're going to lose money. Join my gang, philsgang.com. Thank you for listening.